probably going to be seeing this on April 18th, 2020. This is, of course, the video log that takes 30,000 to a million. And today, I'm going to be talking about some things that it takes for you to sell options in your Robinhood account or any account. This is not exclusively a Robinhood thing. So, but first, before I talk about that, I'm going to run you through the account and show you where I'm at. I'm sitting at $115,000 and about $800, about even today, including the pre-market action. And I'll just run you through the positions. As always, you can pause at any moment to try to figure out what my exact positions are if you're curious about that. By the way, if you're wondering, yes, this is a COVID haircut. I wouldn't be unwise enough to spend money on a haircut like this. What's the COVID haircut? Well, I mean, that's a very good question. It's basically when you take a hair clipper and you just run it all over your head. That's what the COVID haircut is. Okay, here we go. This is the name of the position. This is just a little gamble in honor of one of the commenters in the videos. Didn't expect it to pay off. So this is the name of the position, what the strike price is of the option, whether it's a call or a put, and the date, and whether it's a buy or a sell, and the number of contracts is this number here. It says 1. Sometimes it's 2 or higher. So if you're new to options, don't worry about it. Like, you'll learn what all these things mean as time goes on. So here are all the positions. Feel free to pause the video player at any moment to get a full grasp of what the position is all about. Whoops. And then that concludes the options here. So now I'm going to stocks, and these are my stock positions. Some of these, the Apple hasn't gone through a split yet. Some of these positions have call options sold against them, which is what we're going to be talking about today, actually. So this is not entirely representative of what my account is going to be looking like. Over here you can see the symbol, the number of shares, and from that you can deduct all information that you may be interested in. This is the account tab here in the account. Boom. This is not pure cash that I have because I use it as collateral for some of my options, and I'll show you how to do that in a second. And total return, equity, this is somewhat accurate. Okay, now let's talk about selling options. Okay, that's a great way to earn income, right? Especially nowadays, since the all of the options for options all the opportunities for receiving either dividends or interest on assets has somewhat diminished. We live in a very low yield environment. Environments used to be higher with higher risk. I guess either the risk has gone away or the market's been manipulated in such a way that risk is not perceived by the markets, which results in lower yields. Now, what is a yield? Is the percentage of money that you get when you put an asset either to work or someone borrows an asset, okay, values it enough to pay you interest on it over a certain period of time. Okay, that's what yield is. In fact, when you're analyzing a stock, you can see the yield. Let's take, for example, Apple here. It gives a dividend of 0.68%. Okay, you can take that and you can treat it as a yield for owning the stock. You get that much per year. Okay, a yield is a yearly type of a thing. And so anyways, with all these options that are diminishing, even if you're an experienced investor, you're kind of scratching your head, especially if you're like a value investor or something like that. You're scratching your head how to get yield from today's markets. And so you may start selling options to get some of this yield on companies that you may like. Now, I prefer to try to get yield through options on companies that are near bottoms, companies that are stable, companies that I know are not going to disappear. And the reason the main reason I like stability is because I know that it's near its bottom, and so there isn't going to be any kind of wild swings. And even if there is a really unfortunate event, whether it's globally or locally or just company wide, that event doesn't knock the price down 50%. Okay, because it's so low and near the bottom, you can't compress the value so far down that it makes absolutely no sense. So 20% correction is probably like the maximum you're going to see in some of these companies. Okay, now the obvious question is, well, what do you need? What do I need to start selling options? And that is, oops, one second. Here's what's required. Here's what you need to have into your account. You need collateral. And what is collateral? Well, that's a very good question. It's almost anything that is into your account already. Okay, whether you bought some stocks, whether it's like ETFs or ETNs or any of those kind of vehicles, whether you have just cash sitting around into your account, or whether you've purchased some options. I mean, these are all possible collateral for your trade, for the the move that you're going to be executing soon. Okay, so what collateral means is that you're going to be putting this thing, whether it's stock or cash or options or ETFs or whatever, you're going to be putting it aside, okay, like in a little locked box, and it's not going to be touched for a time period that you specify. Okay, so let's say you make a contract for a month. For 1 month, you can't really touch it. It's there, it's locked out. If you want out of the contract, you can leave the contract at any time you want. There used to be this thing called, I forget, it was like European style options or something, or US, I don't know. There was a different type of style options they trade in other continents like Europe, where you can't actually reach into the box and end the contract early. So you're kind of stuck with that trade that you were initiated in the beginning, and you're stuck with it forever until it expires. So, but in the U.S. and in modern economies, thankfully, we can trade these. So if we find out that we did a bad deal, we can exit out of it, even at a little bit of a loss if it so suits us. So you take this, let's say some cash, and you put it in the box for a month, and then at the end of the month, either the box is returned to you because it wasn't used, or it's been traded for some type of an asset. Okay, and you're going to specify what type of asset that is. So it's kind of an advantageous thing to do if you're patient and you know the values of things that you'd like to enter, and you're okay with either outcome, right? Whether you get your cash back or whether you end up trading it for some type of an asset. Okay, so let's see how this works out. I'm going into, how about Ford? All right, so Ford is a stock that many of you probably hold. It's made a resurgence recently because, probably the Bronco thing. Everybody's excited about the Bronco. But more notably, you know them as the legendary car company of the U.S., etc. And recently had a little social media fight off with Tesla. So Ford seems to have bottomed somewhere around 424 here, and it's made quite a resurgence all the way up to about $7. So almost 100% gain since the bottom in March there. I'm assuming it's March, it's April. Anyway, so many of you own Ford. So let's say you want to lock your cash in, and then at the end of the month or whatever the specified period is, you want that asset on the other side of the trade to be Ford. And the great thing about selling options is you can specify all these things ahead of time before you enter the trade. So what you're going to do here is trade options. Okay, you click the trade options button. Of course, you can do that on the phone. The interface looks fairly similar, so you can follow along on the phone as well. And then you click over here, and the first thing I always tell people before you trade options of any kind is pick a date that you're comfortable with, right? So in this case, it's the 18th, right? So we're going to put September 18th, which is about a month away. And now you get to pick a price that you want to purchase Ford at. You know, isn't that great? You want to trade your cash for Ford, so you pick the price you want to pay. So how about $6? It's 7 now, right? Oh, you have to select what you want to do, right? So what we're going to do is sell a put. Okay, we sell a put, and we're going to lock that cash out for a certain period of time. All right, so let's say $6, which is a full dollar below the current price. Okay, that's quite a bit. It's more than 10%. Can't do the math right now. And so you're going to select that. And so now you're going to be selling a put for about $8. I'm going to click continue. One contract. Let me see if that shows up. Okay, one contract. And it's probably going to ask for a limit price, which is, you know, over here you enter the limit price. It's always limit by default in Robinhood. There's no market price for options. But it looks like the bottom side of it is 7, and the top side is about 8 cents per stock. So it would equal out to about $8 total, because every contract in the options world is traded by hundreds. Okay, so you can feel free to multiply this by 100, so you get $8. So if our trade executes, then we're gonna get paid $8 to lock 600. See where it says collateral? To lock $600 in a box, virtual box, okay, that's kept at Robinhood. I don't know if you trust that or not, but I trust it. Okay, so 600 collateral. So they're gonna take $600 out of your account, put it in a box, you can't touch it, and give you $8 in return. Now, if the stock is above this $6 level on September 18th, you get your collateral back. All right, you get the box and the key, and you take your $600 back, and you still have this $8 here. Right, so you end up with a total of $608 a month from now. Okay, which is a pretty good interest. All right, it's very good. Very good. Let's see if I can do some math in my head here. That's 80, so $96 per year, something like that. $96 per year. That's like, I don't know, high teens percent, like 20% or something. I don't know. I haven't done the math, but it doesn't matter. It's a really good yield for your money. So if you keep rolling this over, you will get a fantastic yield. All right, so that's how you sell options on Ford. Once you own Ford, all right, let's say it goes wrong. Oops. How about, let's see, sell put September 18th. Let's say it goes wrong and Ford drops down to, like, let's say $5.50. You will be required to trade this collateral of $600. Okay, this collateral of $600, you'll be forced to trade it for 100 Ford stocks. Okay, and now the stocks will be priced at 5.5, and you'll have 100 of them. So your stock's value will be $550, which is less your initial locked amount of 600. And that's the gamble you have to take. Okay, that's the downside of selling puts. You might end up with an asset that's not worth as much in market value as it once was, or as you want it to be. You can play around with this, right? So you don't have to sell a $6 put. Let's say you sell a $7 put. Okay, you can sell a $7 put. So the price is pretty close to $7, and you're making a bet that in a month it's going to be still around the same price or higher, in order to collect not $8, but $33. Okay, so now we're talking some monstrous yields. Okay, yields that would make any investor just thirsty if you're able to pull this off month after month. Yeah. So would be locking away, well, it should be $700, but anyway, because I'm doing, I don't know why it says 600. Let's start over. Yeah, there you go. I corrected to 700. So we're locking away $700 this time because we picked a higher strike price. It's called the strike price, the price that you pick. Now at the end of the month, you'll be trading the 700 for 100 shares of Ford. And if the price is above that, a $7 price, the price of Ford is above 7, then your options contract will, it's going to expire, right? It's called expiring worthless. So your contract will expire worthless, and you get your $700 back plus the $33 in what's called premium. Okay, so you get $33 premium, $700 collateral back in your pocket, and you've made some really, really nice returns. Now that's cash, but what about things like ETFs or stocks? Okay. Well, let's make an example here. Let's do an example. I have some stocks here. How about NYMT? Okay, New York Mortgage Trust. It's a very popular holding on Robinhood. I think it's in top 10, maybe even top 3. A lot of Robinhood people own it. You have a bunch of, let's see, I've already sold some contracts against it. It looks like I've sold a lot. Okay, let's go to a different one. I've sold contracts against all of it. Okay, royalty income. All right. I don't plan on selling calls against this company, but I'll show you how it's done. So let's say I have a bunch of royalty income in my account. All right, or you can do anything. You have Ford, you have new NYMT, doesn't matter. What you're gonna do here is click trade options as usual, and then of course the first thing you always do is pick a date. Let's pick a month out like usual, and then I want to, instead of selling a put like we did when we have cash, since we have a stock, we're going to sell a call. All right. Now, you don't have to know why you're doing this. You just have to know what to do, okay? Maybe I'll explain how this exactly works in some other video, okay? But I'm kind of going backwards a little bit. I want to go a little bit in depth of what option selling is with this episode here, because I just always talk about premiums and collaterals and glancing over little details, but I think that I'm losing a lot of people in the process. So with this, I'm trying to educate whoever's a little bit new to the game to kind of get up to speed on some of the terms. All right. So we're selling a call. Okay. So what that means is instead of locking away the cash, we're going to be locking away in the box the stock. Okay. So we're going to not do anything with the stock for a month, and then because of that, in return, okay, we're going to be collecting some premium. So the stock price right now is 62.10. So what you want to do, or what I want to do, what I do usually is I pick a price that's higher than that, so the stock has some room to run. Okay, so near the money, it's called near the money. When it's very close to the price, it's called at the money, and when it's below the current price, it's called in the money. All right, so out of the money, at the money, in the money. That's the terminology. It looks like if I sell a $65 strike, okay, call option, this one, okay, looks like I will be getting about $70, because it's 70 cents times 100, that's $100, that's $70 of premium. Okay, so that's $3 higher than royalty income is right now. I choose the number of contracts I want, which is 1, because I have less than 200 shares, but more than 100. And now I can review my order. Look what it says for collateral here. It says 100 shares of O. O is royalty income. That's the ticker symbol. So that's what I'm putting up for collateral. Collateral means what do I have to lock away in order to get paid? That's what it means. And so the credit here, right, means my reward. Okay, what I'm gonna get paid. This is my premium. It's called premium. $70 for 100 shares. So I never actually have to sell my shares. I never have to do anything. But when that date comes, excuse me, when that date comes on September 18th, if the price actually is above 65, then I'm gonna have to sell my 100 shares at that level. Okay, so I picked the strike price of 65. If the stock goes higher, I'm gonna have to sell 100 shares. That's it. Remember though, you can exit out of this contract at any time, thankfully, but at a price. This contract keeps trading in value, changing in value every day because it's traded live on the exchanges, right? So this is what's called a derivative, right? So options are a form of derivative. So whenever you hear like, oh my gosh, I just realized that I haven't hit the browser. So I'm gonna quickly go through it again. No edits out here, okay? So $65 strike price, you can see it here. This is my collateral, 100 shares of O. Then $70 my premium. Okay. So if the price of the option of the underlying asset, which is realty income, goes above 65 in a month, I'm gonna have to sell at 65, even if it's like at 100, right? Even if it's $100, I'm gonna have to sell at 65, which is a shame. And that's the risk that you take when you sell calls, is you agree to not participate in the upside. Now, these things are traded live, right? When you lock that collateral up in a box, you can trade that contract. So let me show you a contract that's been traded live right now. So any option really. How about the ones we talked about, NYMC? No, I'm sorry, NYMT. NYMC. It's like NYC, but add an extra letter in there. Okay, so you can see that this contract's kind of choppy because there's not a lot of liquidity, but it does change in price. See, from 18 to 15, down to 13, back up to 15. And you can even pull up a weekly chart and an all-time chart since I first sold it. So it's a $3 call. Right, this is the weekly chart. You can see how it's changing. And normally, these contracts go down in value as time goes on, especially if the price of the underlying commodity or underlying asset, which is NYNT at the moment, stays fairly stable, which what has been happening. Options in general are depreciating assets. Okay, so they're derivatives, they're assets, and they depreciate. Kind of like a car depreciates over time. A lot of people have an easy time understanding that. So options are the same way. They go down in value over time, but they have a chance to pay off, right? So let's say the car becomes an instant classic and people are all of a sudden starting to pay a much higher price tag than the one you paid when you bought a new. It's like a collectible. In this case, it's an appreciating asset, yeah. But you got to make that gamble. You have to make that determination. It's the same way with stocks and options. It works the same exact way. Okay, well, exact. It's an overstatement. Now, what's the last thing? The last thing is you can use options. So we used cash, we use stocks, and we pretend that the ETF, ETNs are the same thing as the stocks. The last thing we can use is actual options. So how would you do that? I mean, it's very easy, and you can even do it. You can even do it when you purchase the option. You can immediately sell a call option against it. Okay, so let's say I have Apple here, and I just purchased it, which I haven't just purchased it, but let's pretend. And then view all options. I'm going to go to the expiration date, which I think is June 18th, 2021. Wow, that's a nice in the money call option, huh? I bought at 300 here. It was Apple was around that price, a little bit above, I think, at the time of purchase. So what I can do now is I can sell a call against this option. Okay, let's say current price is 458. I can do the same thing as if I own the 100 shares. But instead of owning the 100 shares, I just have an option, right? And let's say I want to sell a call against that option for that same expiration date. And I'm betting that basically Apple is not going to go above 500, which it might go above 500, but I'm not saying that my speculation here is going to be accurate or not. I'm just doing this for an example. Okay, now what I'm going to be getting paid here, so let's see, one contract, preview order, I'm going to get credited $4,580. So that's quite a bit of premium. But remember that the duration is very long. This is out to next year, and it's also a very expensive stock. Expensive meaning just the number that the ticker holds, okay, like 458 and 80 cents. That's what I mean by expensive. I don't mean that the valuation of the company is expensive, which it might be. Actually, it's Apple, it's expensive, but it just means that, you know, the ticker price is high. So that's why these numbers get enlarged based on the ticker price. So $4,580 in premium. Okay, and it wants me to enter a limit price because it has a really wide bid-ask spread. So it wants me to enter a price that I think is likely to get filled, right? Because there's a difference. Look, the people are bidding 4,525 and people are asking 4,635. So over here, it's asking you to pick, you know, a price somewhere in between those two numbers where you think it will hit, it will execute. So you may have to quote unquote work the trade. There's another term for you. Work the trade. And then I can just press this button and enter that limit price, and then, you know, wake up tomorrow, the trade might be executed, and I might have an extra $580 in my account. And instead of locking out my, let's say I had 100 shares of Apple, instead of locking out that 100 shares of Apple, I would be just locking out that option, okay, which I paid not too much money to acquire. All right, so that's how it works, and you can set that up at the same time, and it has a name for it. I'll show you how to do it right now. So first I go to Apple. Apple's a really popular stock, so I like to use it for demos. And then trade Apple options. I can pick, I gotta pick, right, again, the date. Let's say September 18th. We've been working with that date for a while. And so I can buy a call in the money. All right, let's say a $440 call. And I can sell a call out of the money, let's say at 480. All right, so here's what's going to happen. Oops. Contract 1, review order. See what it says up there? It says call debit spread. So what I've done, it's an actual term that Robinhood recognizes. This is what's called an option strategy, and it's a term it recognizes so that it tells me what's going to happen here. So the max cost is going to be $1,885. So instead of me receiving just premium, I have a net cost to initiate this trade. So why would I do this? Well, for many reasons, but let's just look at the little details here first. So I'm getting in premium $1,105 because we multiply by 100, right? And I'm paying to purchase the trade, to purchase the Apple call, $2,990. Now, if you subtract those one from the other, you get $1,885, which is going to be the cost for me to initiate this option strategy. So what's going to happen here is in a month, if the price of Apple is above the current price, right, and below 480, I'm going to be an absolute, I'm going to be very happy. If it's above 480, I'm still going to be very happy, okay, because that will put me at my maximum value gained. Okay, so I can calculate it right now, but I'd have to calculate, take 40, what is that? 40 times 100, 4,000 minus the cost of it, like 1,000 something. I'd be winning like 1,000 something dollars, right? I think. I'm just doing it on top of my head. If you know the calculations, you can do it. You can let me know in the comments. So anyways, I'm going to be getting paid some money if I do this, right? So I can actually sell a call option against an option. It's very cool, and it's called the call debit spread. So now we figured out that you can use a variety of things, okay, like stocks, ETFs, cash, or options to sell options against and collect yield. All right. So if you were interested in starting to sell options, this is how you do it on Robinhood. Of course, you can use any other brokerage account. It works just the same exact way, but it's just, in my opinion, a little bit more complicated, and other brokerages just not as clean. I don't like it, and that's why I use Robinhood myself, although I have used other brokerage houses like Interactive Brokers and E-Trade, and I used Share Builder before I got bought out by E-Trade. So those are the ones I'm familiar with. A lot of people seem to like TD Ameritrade, and but personally I like Robinhood the best because it's just sleek, cool, simple, and I just enjoy doing it. But hopefully you are on your way to selling options. If you are interested in it, it could provide, it's called, income, options income, although it's not that reliable, so I wouldn't treat it as income, meaning like you go to work, you get paid $1,000 or whatever you get paid, and then you go home and you can count on that check month after month or if your company goes broke at some point, then you have to look for another job. But it's not a reliable, right? So sometimes, a good percent of the times, you're having to buy that asset, and that asset might be valued too low for you to make your money back by selling a call option or just selling it straight into the market. So you are taking a risk, you are going to have some losses, and of course this stuff, there's always a lot of risk, and if you are unsure about what to do, or if you're confused, or if you need help, always you should contact like a licensed professional, and make sure that you know that you can lose everything in the markets, and you shouldn't really play, especially doing these kinds of complex strategies. You shouldn't really use them with money that you're not willing to lose. So make sure that you're like checking your risk tolerance, and you know that you're going in with the mindset that you might lose that money, the same way you might go into the mindset of into a poker game or like casino, playing the slots or something. Even though there might be a higher chance of winning than the slots, things could still go wrong, and basically don't bite off more than you can chew is the advice there. Okay, this has been one of the longest videos ever. Hopefully it hasn't been boring. I don't know, but I updated you my account, and also showed you how to get started with options trading if you don't know already, and also try to catch you up on some of the terminology there. And I think that's about it. Okay, hopefully I'll make another video on Thursday about some more philosophical things I have in mind. Alright, but for now, I'm going to end it right here. So peace out.